Welcome back, FinScribble family. Today, we are exposing a hidden trap that millions of passive investors are falling into without even realizing it. Meet Maya. Maya has a round head, short, choppy hair, a simple line body, and wears a plain crew neck shirt. She feels incredibly smart because she just poured her hard-earned savings into a broad market S&P 500 index fund. To Maya, this is the ultimate financial safety net. She genuinely believes her money is perfectly spread out across 500 distinct, thriving companies, protecting her from any sudden market shocks. After all, that is exactly what traditional financial advice always promises, right? Diversification means absolute safety. But what Maya does not know is that underneath the glittering surface of her set and forget investment portfolio, a major structural shift has quietly occurred. Her supposedly safe and balanced financial safety net is actually standing on an incredibly fragile, top-heavy foundation. Enter Jordan, our analytical guide, who has a round head, slightly longer, messier hair, and wears a clean collared shirt. Jordan notices Maya celebrating and decides it is time to gently pull back the market curtain. To explain the hidden risk, Jordan hands Maya a beautifully woven fruit basket labeled Market Index. Maya expects to see a colorful, perfectly balanced assortment of various healthy fruits. Instead, she looks down and is completely shocked by what she finds inside. Pointing, squatting right on top of the pile, are 3 colossal, heavy watermelons glowing in a bright, warning amber accent color. These 3 massive watermelons completely dominate the space, utterly crushing a few dozen tiny grapes and minuscule blueberries at the very bottom. Jordan explains that this lopsided basket is exactly how her index fund looks right now, completely dominated by just a tiny handful of massive tech giants. Let us break down the cold, hard math of how this happens using market capitalization weighting. Jordan draws a large scale on the board to show Maya how modern index funds actually allocate her cash. In a market cap-weighted index, the amount of money you invest in a company is directly tied to that company's total stock market value. Maya assumes her dollars are split evenly, but Jordan shows her the startling reality on a stark bar graph. Because a few tech monopolies grew to multi-trillion-dollar valuations, they now command a staggering 30% of the entire index. When Maya invests a single dollar into her index fund, nearly 30 cents goes straight into just those top 3 glowing, warning amber tech stocks. The remaining 70 cents is thinly stretched across the other 497 companies, making her portfolio dangerously reliant on a single sector. This extreme concentration creates a massive hidden risk that most passive investors completely ignore until it is too late. Maya looks at her fruit basket again, finally realizing the terrifying structural flaw of her current investment strategy. If one of those giant, warning amber watermelons slips or suffers a major financial crisis, the entire basket tilts violently. Most people buy index funds, thinking that if tech stocks crash, the other 497 companies will save them. But Jordan shakes his head, showing a collapsing line graph where the top tech stocks drag down the entire market average. Because the index is so top-heavy, a bad week for just 3 corporate giants can completely wipe out the modest gains of hundreds of other smaller, healthier businesses. Maya's diversified shield is actually an accidental bet on a tiny, fragile tech monopoly. Fortunately, Jordan has a fantastic alternative to show Maya that restores true balance to her investing strategy. He introduces a brand new concept called an equal-weighted index, drawing a completely different style of fruit basket on the whiteboard. In this balanced basket, every single fruit, from the largest watermelon to the smallest little grape, gets the exact same amount of physical space. Translated to the stock market, an equal-weighted fund invests the exact same percentage of your money into every single company. Maya looks at Jordan's new chart, noting how the three warning amber tech giants are now scaled down to match everything else. If those tech giants take a massive dive, her portfolio remains perfectly stable because the other hundreds of companies carry equal weight. This simple adjustment instantly transforms her from an accidental tech gambler back into a genuinely diversified, safe investor. So, what is the ultimate takeaway for your personal portfolio today? Neither Jordan nor I are saying you should completely panic and dump your favorite index funds. Market cap weighted funds are still incredibly cheap, highly tax-efficient vehicles that have built massive wealth for millions of people over decades. However, true investing mastery requires you to look beneath the surface and understand exactly what risks you are holding. Maya now looks at her portfolio with absolute clarity, feeling empowered rather than anxious about her financial future. If you want a truly diversified safety net, consider blending your standard index funds with an equal-weighted fund to balance the scales. By taking control of your allocation, you protect your hard-earned savings from the hidden traps of a top-heavy market. Keep learning, stay smart, and always look closely at what is inside your basket.
As always, appreciate you hanging out today. See you in the next one.